Alright, hello everyone. So somebody in my comment section asked me what my model was and my strategy. So I'm just going to be talking about that. Let me pull up the chat in case anyone joins, has questions, but I'm going to go real quick over the model and then I'll go over the trading plan. But this is my model. Where basically if I have to draw it on a piece of paper, there is the bullish model and the bearish model there. So this is fractal, right? We'll work on any time frame, but I use the 15-minute chart, and then that's to qualify the PD arrays. And then I go down to the 5-minute chart. That's to qualify an order block or a breaker, which is where I can start to find entry PD arrays, all the way down to the 1 minute, or even actually 30 seconds. But usually we'll just leave it at 1 minute. So the 15-minute, it can also be an hourly PD array, and then I drop down to the 5-minute, or 15-minute PD array, and I drop down to like the 2-minute or 1 minute. But usually there's going to be a 15-minute PD array. So 15-minute PD array, that's my higher time frame PD array. And we'll have the same thing up here. And within this PD array, or where this PD array is going to be in a discount. So wherever 50% is, it's going to be in that discount. So it's a discount PD array. Let me just add that. Okay. And within this, there's going to be a small run on short-term stops. So this is where I use the 5-minute. I like to see a 5-minute low, but sometimes they can be close by and it's not a swing low, and that's when there's a 5-minute order block, or else it's going to be a 5-minute breaker. So I can go down a lower time frame, and if I see a spaced out low that's a short-term low on the 1 minute, then if we get a quick run beneath that and we start to close beneath the short-term low, then I can see another run higher. And I often describe this as accumulation, manipulation, distribution, as ICT does. That's the formation of an order block. An order block forms by doing accumulation, manipulation, and distribution. So you'll get this initial run higher, which will get people into early longs. As it comes down, it hits a level of support or near a level of support, and or retrace, people go short, and then it goes down, it lets people make money, or it stops out the early longs, and that's when the smart money has liquidity. Throughout this entire area, smart money has liquidity to go long, right? And then price runs higher after it takes out this low. And I always put an X on it because that's like the main thing that I look for, is that X. So you can show how that looks like on the charts, like from yesterday. Right, so yesterday there was this 15-minute fair value gap that was created during 8:30 news. We had hit this order block, higher time frame PD array, and left this large fair value gap. And this was a market structure shift, so I noted that, and I wanted to see price at 9:30 consolidate, chop around, maybe make some people think we're going to go higher, get some people in trades both ways. We're above that midnight open, and then you go down to the 5-minute. So what I'm waiting here is after 9:45, the opening moves around a little bit. We mostly went lower, so I'm not looking for immediate lower prices. We get an initial run up. Now we create this 5-minute short-term high, and that's what I was waiting for, a 5-minute short-term high. We come back above the 5-minute short-term high, and I was a bit uncertain as we're coming up above it, but as we form this small 5-minute candle, the body is closed slightly above this 5-minute short-term high, and this is getting ready to be an order block. So I wanted to see if it would be an order block, and I went short above that high, and it brought it down there. That's accumulation, manipulation, distribution. So simply my model is just accumulation, manipulation, distribution, and I try and make it fit inside a market maker sell model, so a higher time frame market maker sell model or buy model. Right, and another example I did not take but happened yesterday was Monday. So you go to the 15-minute chart, and this is the only other example I'll show before I move to the trading plan. But you see the hourly, this is an hourly order block or 4-hour order block. We came down to hit it at around 9:45. We took out these overnight lows, so all night, if you look at 1800, which is when the Asia session opened, all the way to 6 a.m. in the morning, this is all overnight session. We came down and swept all that liquidity, but we still have the highs. So we run up to the highs. You have the 4-hour order block. So now you drop down to a 5-minute chart, and you get a nice run here where you have the short-term low beneath these relative equal lows, and another run lower, and then quick candles creating that change in the state of delivery, leaving an order block, and price coming back to that fair value gap. Is again accumulation, manipulation, distribution. Right, so that's my model. It happens very often, and it's a little bit discretionary too, right? Because it's mostly just concept. It's a concept. It's not. I don't use indicators. I know some people don't use squiggly lines. I used to do this. As you can see, I have a lot of indicators on my chart. But yeah, they'll use like squiggly lines and heartbeat indicators that tell you what your heartbeat is, whether you should go long or not or short, and just try and they think that this is what moves the market. It's not. This is what moves the market. What I explained: accumulation, manipulation, distribution, because all the markets are manipulated. And so I just read the manipulation, and if I think that I can go long or short, I'll do it. That said, I have a lot of rules, right? Because it is discretionary, I have a lot of rules. So now this is where you get to the trading plan. So the trading plan is different than the actual model or the pattern entry, because this isn't really a pattern because there's a lot of concept and theory behind it. So this pattern may show up very often, but not all the time am I going to take it, because I know that sometimes I know when it's going to fill or when it's likely to fill, right? Like for example, if you look at, maybe try and find an example where over here, right? We had this 5-minute short-term low. We came down and hit it. And we could say that there's a higher time frame order 50. Let's say there's a 15-minute fair value gap, like here. Okay, we came down, we hit this 5-minute short-term low, we expand, and I want to buy off of this inverse volume imbalance. All right, I know this is not going to work because we're in a premium and we're near these highs, and I'd wait instead till we take out these highs, and then we run lower, right? So we take out. We were left relative equal highs there. So, or I wait till the right time. It's 3 a.m. I wait till the right time. We get another run back to the 15-minute fair value gap, and then we take out the overnight session lows. The point is that I'm just reading where market's going to go based on where the liquidity is. So now to the trading plan. This is my trading plan. So there's a lot here, and you can read through the beginning. Like this is just like the beginning is just my schedule and when I don't trade and things to do. Then this is my arsenal. So everything that I use to get into a trade, every concept, there's the inefficiencies. So I forgot what price delivery is. No, that's not price delivery array. Bullish or bearish? Yeah, I think that's what it is. But fair value gaps, inverse fair value gaps, buy side and balance, sell side inefficiency, sell side and balance, buy side inefficiency, breakaway gaps, measuring gaps, implied fair value gap, which is the BPR, balance price range. And that's ICT mentioned what a he called something an implied fair value gap and they never talked about it again. That's basically a balance price range. Is when you take like from that wicks high down to that wicks low. Right, this is a balanced price range because if you go down to the lower time frame, you'll have these wicks that went up and back down, and it probably created a fair value gap up because it was a really quick up and then really quick down, and then really quick down, really quick up to move through that wick. So it likely left a balanced price range on the smaller time frame. But back to this. So order blocks. All right, there's a traditional order block, or the bearish or bullish order block. Then there's reclaimed order block, breaker block, rejection block, propulsion block. Market profiles. I use the IPTA data ranges 60, 40, 20 days and 72, 48, 24 hour look back and cast ahead. The weekly or daily profile, basically the accumulation, manipulation, distribution on the daily chart or weekly chart. Power 3, accumulation, manipulation, distribution. Then I look for equilibrium where premium and discount is. The dealing range. So this is like if the London session made a buy side or sell side run, I'm going to trade within that or wherever the dealing range is. That dealing range is a range that took out sell side and buy side. And so you want to trade within those and project those because you're going to have a breakpoint or landslide condition, which is, if I bring that up real quick, this isn't something I trade because it's pretty hard to trade, but this is like the first model I basically ever came up with, a breakpoint or landslide. You'd have a breaker form, manipulation, and usually I would get in down here, right? But there's another entry once we get above the dealing range. Let's say this is the London session. London session makes a high and low, then New York session gets above it, and then 9:30 can take off, and this is sometimes going to happen in the afternoon too, or lunchtime after the morning kind of consolidates and leaves the dealing range. That will happen very often actually ahead of news where the morning is, or after a large range day where the morning, you expect it to be choppy, then the afternoon's going to perform, or lunch is going to perform by getting above all this consolidation left by a dealing range during the 9:30 open, which took out buy side and sell side, and price will just take off. There's a market maker buy model, smart money technique or SMT between the Dow, the S&P, and the Nasdaq. The regular trading hours profile, which is just if you toggle regular trading hours, I look at the regular trading hours gaps. And what is it? Quarterly theory. That's days thing. I don't use quarterly theory as much. I used to look at it very often, but that's basically, if you don't know what it is, you should search it up. It's basically time is fractal, and you split from the years of the quarters of the years, like Q1, Q2, Q3, Q4. You apply the same thing on like the 15-minute chart, the hourly chart, within a day, within a week, within a month, within 22-minute quarters, and then so on, and within 90-minute quarters. So we have the market opens and macros, the open, high, low, and close of a daily chart. Midnight open, which is I call it the true open. It's the barometer where this is why I always put the midnight open. It's not part of my model, but it's part of my trading plan. So this is a tool that I use within or with my model, with my entry pattern that I showed up here. I use that tool within this. So all these things I'm using within my model or my entry pattern. 9:30 open tends to finish off the pre-market manipulation stage and distribute into the 10 o'clock hour. And then 13:30 is the PM opening price, barometer for overbought or oversold for the PM session. And then I use the macro times I mentioned in the morning, the 20 minutes within each hour. Then lunch macro is a good time to see morning reversal or a continuation of the London session or overnight session. Last hour macro is a good time to see daily reversal to close lower than the high. And I have the draw on liquidity, long-term highs and lows, or that's basically spaced out highs on multiple time frames, or also called old highs and lows. Relative equal lows or highs, previous day highs and lows, previous session highs and lows, 15-minute bullish PD arrays in opposing equilibrium areas, or vice versa, and projection levels, which I don't use so often, projection levels, but it's something that I look at sometimes. Session rules: do not trade a session if the previous one trended and is bigger than its past 5 ranges. You see me mention that sometimes. If London took out Asia high and low, don't trade unless it consolidated with Asia. Only trade PM if AM is expected to chop. Only use macros when price is in a range. Trade only what you outlined ahead of the session. Do not react. Plan and execute on the plan. So I often come in with a bias and I say, okay, I want to see price go lower, or if it hits this area, then I would want to see it go higher, and then I trade off of that. If something else happens, I don't trade. Unless price is reversing, outline the opening. And I always try and pick one direction. Sometimes I have to pick 2, but I always just try and pick one. So it minimizes the... usually if you just pick one direction, and if you see it happen, you're going to have a lot more consistency, because something else happens. You're not guessing and you're not reacting based off new information. You're less likely to gamble and go off the rails if you just pick one direction and stick to it. If a session has traded within a previous session range, wait for an extreme to be triggered, then aim for the other. So this is a seeking to short profile. Make sure price has a higher time frame draw on liquidity, so make sure that it's actually reaching for something. It's not just consolidating. This is in a reversal profile. Price initially traded in X direction and came back to qualify a 5-minute breaker. This is basically accumulation, manipulation, distribution that I explained in the beginning. Execution process: figure out what the session bias is and don't do anything not outlined in your journal ahead of time. Determine your dealing range and level of equilibrium. Identify where the manipulation occurred or will occur. Look for a draw on liquidity to distribute to. Identify a breaker qualified by a break of a 5-minute high or low, or look for the formation of a 5-minute bullish order block. This is what I explained here, right? I look for a 5-minute breaker to form or a 5-minute order block to form. And that range from low to high, that's going to be the breaker from the short-term low to the high, which would see the market structure shift. That would be the breaker or order block. So I try to get in within that area, and oftentimes then price can retrace and create a 2022 model and go higher. And I always have another entry if it doesn't do that. But I try, and my motto is to get in at the reverse, like a turtle soup sort of. Find a PDA that lines up with the AMD model, enter in function with risk parameters, and this is my risk parameters. I have things like what happens if I'm in a trade for too long, because I know how I'll react to that, but this can be different for a lot of these things are going to be different for everyone. Not everyone's going to want to use the same PDA arrays that I use and the same rules that I use, but this is like based on how I feel. After 15 minutes, I don't want it to come back to break even. And so I have these things there to protect me, right? But some people may feel comfortable with re-entering, and then some people maybe feel comfortable with taking 10 trades in a day instead of 2. I usually, in the past 6 weeks, I averaged 1 to 2 trades a week. So I'm not even, this is 2 trades a day max. I'm far from that. But yeah. market maker buy model, this is another tool that I use in the arsenal, but this is where I try and frame every single one of my trades. So whenever I'm trying to trade within a market maker buy or sell model. If it's not doing a market maker buy or sell model, then it's getting ready to do one and I'm waiting for it to happen. So all my trades, I try and frame them within a higher time frame market maker buy model. Sometimes it doesn't, it's not there. I think we're in one and it's not like happening, but I try and use these concepts of a market maker buy or sell model, and you see accumulation, manipulation, distribution happens very often here, and that's how I try and frame every single one of my trades. And yeah, that's these are just examples of market maker buy model. But yeah, that's my trading plan, and then the trading model. So hope that answered the guy's question in the comments. Hello, Amasha Lama. Sorry, I just saw your comment. Yeah, I was just explaining my model to somebody who asked in the comments. I didn't want to make a whole video, so I decided to just make it a stream. But anyways, I'm probably gonna end the stream now, unless I'm not sure you have a question. Alright, well, I'm gonna end the stream then. Thank you very much. Have a good day. If I know how to, yeah, there you go.